after Bloomberg broke news that the mall owner is said to be in takeover talks with Brookfield. Bloomberg's Eric Schatzker joins us with an investor who's been making the long case for GGP and saw this takeover bid coming. Eric, take it away.
Julia, that would be Jeff Olin of Vision Capital Corporation joins us from Toronto. Jeff, good afternoon to you.
Good afternoon.
Jeff, your fund tries to find mispriced real estate assets in the public markets. And 3 weeks ago, you made what appears to be right now, at a conference in which we both participated, you made what appears to be a prescient and timely call that Brookfield would have good reason to buy GGP. As Julia just mentioned, we've reported that Brookfield is indeed in early stage talks to buy GGP. And I have to ask you this question. Did you know something?
No, you didn't have to know anything except read public disclosure. If you read every quarter, Bruce Flatt, the CEO of Brookfield Asset Management, puts out a letter to shareholders. And if you read the first quarter report, there's one page in there in retail where he makes the case for doing everything but buying GGPs explicitly. And in there he says, and I think I largely quote, there's a significant disconnect between public market and private market valuations in retail real estate, and we intend to capitalize on that difference. So they've wanted this for a long time. They recently increased their ownership from 29 to 34%. It's some of the best real estate in the planet. The GGP owns 100 of the top 500 malls. I think they intend to, ultimately will, and think they should. They'll do so on their time, in their method, but it makes a lot of sense.
There's one problem for those of you who are GGP shareholders, and it's that Bruce Flatt has been successful at Brookfield because he's a cheapskate. And we've reported, as you probably know, that Brookfield has looked at paying a premium to market of 10 to 15%. Is $21.85 all you GGP shareholders are really going to get for this company?
No, I think that pricing, and I don't disrespect your network or your source, is a silly number. The net asset value of GGP is about $31. That's at a 5% cap rate. For those not familiar with real estate, if you take the net operating income and divide it by what's known as the cap rate, you get value. The lower the cap rate, the higher the value. The value around, according to Citigroup, is around $31. That's at a 5% cap rate. It's trading today at close to a 6.5 cap rate. You know, they've been selling Fashion Show Mall in Las Vegas at a 3.7% cap rate. The Ala Moana Shopping Center, interest in these malls in Hawaii, at a 3.9% cap rate. If you put a 4.5 cap rate on there, that's $36.50. So I don't think that number is credible. I think if it occurs, when it occurs, it'll be at a higher price than that. Do I think we're going to get $31? Not necessarily in this environment, but I certainly think it's worth that.
You know, there's also the possibility that someone else may take an interest in the 66% of GGP that's publicly traded. Brookfield owns 34% already. Can you see either one of two scenarios playing out? A competitive bid, if you will, for that 66%, someone going up against Brookfield, or something different like a breakup of GGP in which, say, Simon Properties gets some GGP assets and Brookfield gets the rest?
I think with perhaps the latter opportunity is more likely if Brookfield doesn't do one on its own, which I think they're the smartest guys in the room. They have the capacity to do it if they really want to. But it is big, so a partnership with others does make some sense, and perhaps spinning off some assets is something that has potential.
Jeff, you mentioned that in your view, GGP has 100 of the top 500 malls in America. And it is, of course, true that not all malls are created equal. Why is it, though, that you want to own, that you feel comfortable, A, valuing GGP's assets, or at least giving them a relatively, I won't call it generous, but not a discounted valuation, given the fact that we're talking about an industry that is the iceberg melting in the desert?
Well, this is not melting in the desert, and that's precisely the opportunity. If you read the Wall Street Journal every day, how many articles are there of retail death in the mall? The opposite is happening in GGP malls. Yes, Sears, J.C. Penney's, Macy's are closing, but in these malls where 56% of the U.S. population live within a 1-hour drive of GGP mall, they're replacing Sears and J.C. Penney's that are paying them $4 to $7 a square foot rent with more vibrant tenants, Apple stores, Zara stores, H&M, Cheesecake Factories. Not only they're getting rents between $20 to $60 or more for these former department stores, but they're improving the malls. So it's the biggest misnomer. All malls are not created equally. This is exceptional real estate. It's not going away, and it's nothing new. Retail has been transitioning forever. 25 years ago, Kmart was a darling tenant. This is a good thing, not a bad thing. It's a unique generational opportunity right now.
Jeff, a pound the table argument in favor of GGP. I want to thank you for joining us very much. Jeff Olin of Vision Capital Corp.